Zoom's looking quite expensive. So 100 billion market cap, it generates $2.5 billion revenue. And I prefer to be invested in stocks that are going with the wind rather than going against the wind.
Hi everyone, we are in for a very special treat today. We have, in my opinion, another very, very talented, skilled, popular investor in eToro. We have James Campion joining us in the podcast. James, how are you?
Very well, thank you, Marvin. I'm very honored to be here.
Before we go into the specifics of how you trade, what's happening to the markets right now, can you give us a background also on how you got into investing, so that at least it inspires a lot of people that they may think that trading in general is something that is too hard to get into?
So I entered banking wealth management at the beginning of my career 13 years ago. And I started by building a book of clients. And over time, that sort of evolved into being predominantly guys and girls in the industry. So I essentially became a banker for bankers. And at that point, I was headhunted over to ADCB, who had just bought RBS and ABN AMRO. And they had a large book of high net worth and ultra high net worth individuals, where I got the exposure to work with some of the world's wealthiest people and help them manage their wealth. And it's such an integral part of most people's life. It's just fascinating. It's always changing. And it's really rewarding to see how the right advice can really help people out.
Applying your experience handling portfolios of a lot of high net worth individuals, what has spilled over in terms of your technique on analyzing and trading for your own portfolio? Creation
of wealth is pretty common across everyone, right? Everyone has very similar goals. And contrary to popular belief, actually, wealthy people are often less interested in generating huge returns and more interested in generating security and regularity of income. And it tends to be people earlier in their career that are more interested in growing wealth, which is fantastic. But essentially the principles are the same across everyone. I think, being invested is just a fantastic opportunity. And unfortunately, I feel like often it's the wealthy that get educated about these sorts of things and get the opportunity to speak to bankers about these sorts of things. And it's sort of less discussed among everyone else. So it's great to give the opportunity, to open that discussion and help people get on the first rung and get invested.
Now, this is what I'm curious about. You mentioned that you've been doing this for over a decade now. Yeah. When did you realize that you're actually good at this and this is something that you can do for a long, long time?
It doesn't matter how many times people tell you that when there's a market crash, it will recover within a reasonably short space of time. When you look back at historical crashes, it's usually months, in some cases a year, and that markets over a long period of time continually go up. When you go through your first crash or you're holding a stock that pulls back pretty hard, you feel it, and it doesn't matter how many times you get told to not worry about it, you do. And I think over time you start to get comfortable with that feeling. You get very aware and reassured about the benefits of diversification and the best way to manage an investment portfolio, and it becomes very enjoyable.
Out of the 1,000 stocks out there, what's your methodology? How do you filter out what forms part of your watch list? Then as part of your watch list, what forms part of the ones that you actually put an allocation on? What goes through your head before picking?
From a portfolio point of view, the strategy that I run is a core satellite, which means that I have a small number of larger positions in stocks that I have high conviction in, that are very well researched, that I track very closely. Then I have a larger number of very small holdings, satellite holdings, that are hopefully not correlated to my core holdings. So that enables us to really optimize for upside and gains, and hopefully diversifies and limits any downside risk. And then the approach starts from a top-down approach. So I look at what's the macroeconomic environment like, what's the future looking like, and then I'll dive down into an individual holding perspective. And from there, we look at stability of earnings, what's the management team like, what's earnings growth like, debt to equity ratios, dividends, and price to earnings ratios. But in a really simple term, you're essentially just looking at, you're just trying to find something that looks cheap. And that can be cheap based upon historical earnings, or that could be cheap based upon their future growth trajectory. So a popular indicator is price to earnings ratio, which I really love, but it's not suitable across all stocks because it doesn't work very effectively. It's a backward-looking metric, so it doesn't work very well on growth stocks. But you can still find cheap growth stocks because if you project out the earnings into the future, the share price can look cheap based upon those metrics as well. Yeah, so the crucial thing is to look for opportunities, and opportunities tend to be things that look cheap.
A lot of people would use P as a metric for them to look at if it's cheap or expensive. I just want to see your opinion on this. And you have positions on Tesla and also eBay, and you can also maybe put Zoom and AMD there, which a lot of people have mentioned that at their price, even if they have corrected a bit, they might still be relatively at the higher side of things. What's your take on that? And at current levels, why do you think that it's not yet so expensive? And by the way, with the exception maybe of eBay, I have those things that I mentioned as well, and I bought them at current levels too.
Tesla's probably a deeper conversation, but the high level of the Tesla play is that it's looking like electric vehicles is probably going to become a winner-take-most market, and that market is huge. So if you remember when the iPhone was launched, in their first year, I think they had just under 1% market penetration. In their second year, they're about 2.5% market penetration. They weren't selling a lot of phones, although there was a lot of hype. People very much liked the product, and it was the future. It just takes time to come to fruition. And they really got there because they built the chips and the software, the end-to-end user experience, and then they became 50% of the market. And that's essentially playing out in the electric market, electric vehicle markets as well. So that's Tesla. So if you assume whole of market earnings potentials, it still looks quite cheap. And then if we take Zoom and eBay, for disclosure, I'm long eBay and I'm short Zoom. And the reason there is Zoom's looking quite expensive. So it's about 100 billion market cap. It generates $2.5 billion revenue. It's got smaller gross margins than eBay. But also when you look at Zoom even further, it's priced based on its earnings in 3 years' time. And that seems to be an interesting metric because we've just gone through a pandemic where everyone has to be calling on Zoom, and that will change. It's less likely that more people are going to join, I think, over a long period of time. And also, I don't know a company that has so much competition from the majors. So Facebook has 2 video calling products that they offer free of charge. Google does, and I prefer to be invested in stocks that are going with the wind rather than going against the wind. So eBay is a perfect example of that. So it generates about the same amount of revenue, about 2.5 billion. Most of that falls to the bottom line. But its valuation's like 38 billion at the moment, or 40 billion. So it's far better value as a stock, and it's got fantastic growth potential. So they previously owned PayPal because a lot of what eBay does is financial transactions, it's escrow and payment for goods. They sold off that holding, and now they're building in-house their own financial services solution, and that's a high gross margin business. So margins are likely to grow, and eBay is likely to grow over the long term, and it's looking at very attractive rates.
Getting from what you said, you have a high preference on how they're earning and how they could potentially move over the macro, not just specifically. It may be expensive from a PE ratio perspective, but It's more of how big of a space that they could still get. Am I getting it correct?
Absolutely, yeah. And the likelihood that it will be able to capture that space. So in Tesla's case, I think there's a high likelihood, and in Zoom's case, I think there's a reasonably low likelihood.
Got it. I like what you said, winner take all market, Cathy Wood style of investing. And anyways, I want to do a deep dive on this also. You mentioned that you have like when you structure your portfolio, you have core holdings which have a larger chunk. And looking at it right now, it's Cineworld and also Glencore. Does that mean you're cut off, like, for the ones that have a larger positions are looking at your portfolio up until Blink? Is that what you consider your core, and then everything else are supporting it?
Yeah. So the core is the super high conviction calls, and then the others. The decision based on satellite holdings might not necessarily be that company will be the best performer, but it might be that it has little correlation with my core holdings. And the benefit there is that you're introducing diversification and reducing risk at a portfolio level.
Is it that's why you have Cineworld, Six Flags are expecting this to be part of the recovery? That's why there's a position in those stocks?
I think that the price has been suppressed, obviously, because of the pandemic, but also this, I think, misconception that Netflix and other streamers are going to compete for business. But it seems like there's no comparison between, or they're not competing for the same eyeballs at Netflix and Cineworld. And we've seen that since like 1995 to today, every year they sell between, or the cinema industry sells between 1.2 billion and 1.4 billion cinema tickets. Mm-hmm. And since the heyday of cinemas in the 90s to now, that number hasn't changed. The top year was 1.4 billion, the bottom year was 1.2 billion, the average is 1.3 billion. But what we have seen is revenue increase. So the price of popcorn and Pepsi that you buy at the cinema, it's incredible, the increase in concession pricing. So the peripherals that bought with a cinema ticket have increased by 450% over the same period of time, over the last 20 to 30 years. So cinemas seem to be in a stronger position now than they were in the 90s, but I think the market is viewing that cinemas are weak. And in Cineworld's case, they bought Regal Cinemas a couple of years ago for $3.5 billion, which is a fantastic asset, spins off a lot of cash, and it's at a $1.5–2 billion valuation at today's prices, which is just cheap.
As you start to position on those core holdings, how do you determine how you tranche it? Is there a specific ideology that you follow that, okay, this looks cheap already, I'll put X percentage for that particular position?
My core holdings are typically 30 to 70% of the portfolio, and that depends on how many core holdings I have high conviction on, really. There's only so many hours in the day, and there's only so much time to get to high conviction, and there's only so many opportunities in the market. So that determines what percentage of the portfolio is in those core holdings. And then from there, it's just a case of, do we split them up equally, or do I go slightly overweight on one that I have a higher conviction? It's more of an art at that point than it is necessarily a science.
Is there a rule that you have that I must have this level of cash at any given moment in time? Or if you find an opportunity, no matter if your cash goes very, very low, you just deploy capital on it as well?
Cash is typically a risk. I'm holding probably a little bit more cash than I do on average over a long period of time. I try to remain almost entirely invested almost all of the time, because you're really making a decision by being in cash. You're basically saying that going long anything and going short anything is both a bad decision. And if you have the opportunity to go long or short, as long as you have conviction in the market, there's always a right decision to make. And just by rule of thumb, I mean, being invested is always a better option over a long period of time than not being invested. So there is a cost to not being invested that has to be calculated into a portfolio. But during a rebalancing, which I did quite recently, I tend to stagger my entry into the market, especially when there's volatility. And a lot of that comes down to wanting to just buy in at the average price during that week or that month, to ensure that long term I get a good entry price.
You like have a certain position, and then what's your philosophy on it? You want to tranche up, or you like to tranche down also? Because I've seen people that they don't like to tranche up because they always want their first trade to be the cheapest. But I'm just so curious how you think of it.
So whether a holding is in profit or in loss, I make the decision, is that the best use of that capital at that moment in time? And if there's a better use for that capital, then it's better to sell that position, irrespective of how that position is doing, whether it's in a loss or whether it's in profit. And if the information changes, i.e. Conviction increases or risk decreases, then there's absolutely an opportunity to continue to invest in the same stock. And it's important to remember that it's not a case of always trying to get the very bottom and the very top when you're trading. It's about maximizing the opportunity of that capital at any moment in time. So you might have the bottom might have passed, but at that moment in time, it's still the best place to deploy that capital, and to not worry too much about where the bottom and where the top is. It's more about the conviction of that trade and the likely prospects of that company going forwards.
But I like what you said, that you're going to sell because there's a better opportunity elsewhere, regardless if it's cutting losses or taking profits on that position. And it reminded me of a couple of questions that a lot of people were sending, especially when the market, when we saw tech stocks drop more than a week ago. If it was you, or you have a friend that's in a scenario where they bought a certain stock and then it dropped massively, and then the losses are too big already, that they didn't set a stop on it, it's just really too big, do you suggest that people wait for it, or if they really believe in that company, they could add, or just totally cut and then transfer to another position?
So I think you have to ask yourself the question, why has the company, why has the stock price dropped? So there's a few things, like there could be just a beta move or market moving. Maybe investors are less excited about that sector, or there's bigger market movement down, in which case there's less of a concern to worry, because it's not related to that individual company, but the market as a whole. There could be a case where it disproves your thesis. So there was a reason that you purchased that stock. Is that still the case? And if it's not still the case, then I would suggest that that's probably a good time to sell, because you don't want to be holding something that doesn't go along with what you were hoping, as it were. So that'd be a reason to sell. And another reason you would maybe consider selling is if the risk profile of that holding has changed. So maybe the stock has dropped because the company is struggling to borrow more money, and there's a risk that it might go out of business and it might go bankrupt. Now, then you have to ask yourself, am I comfortable with this going from where it is down further? And if the answer is no, then absolutely it's the right thing to move into something that's more suited to your risk profile. I wouldn't suggest holding on to a stock because it's in loss, because it's in a loss, if that makes sense. Mm-hmm. You should always be holding stocks that you believe that have good futures, that will do well going forwards.
There are some that have been holding to 50% losses for X number of years already, and it's too painful for them to let it go right now because it affects their position. But
Zoom represents a stock that's at the very highest level of optimism for the future and at the very top end of its perceived valuation. If there's going to be any jitters in the market or any market pullback, Zoom is going to do disproportionately badly relative to the other stocks that I'm holding in my portfolio.